Is something actually going to happen on June 28th with Basel III that is going to really end this paper gold and silver market as we know it? Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a rather exciting time in the financial markets where, I mean, who would have guessed I'd be sitting here talking about a 5% inflation print? No, that is not John Williams' shadow stats numbers. That's actually the BLS. A lot of things going on, and quite fortunate to be joined by the great Alasdair Macleod of goldmoney.com. And one of, I guess maybe these things come in time and historic perspective, but one of the great researchers of our day, in my opinion, also who has been on top of this unfolding Basel III story that's been popping up, and the data is rapidly approaching. A lot of people wondering what's going on. So, Alasdair, can't thank you enough for making some time and joining me here today, and looking forward to digging in. So, how are you, my friend?
I'm very well, and thank you for asking me, Chris.
Well, thank you for deciphering through all that legal jargon. I did go through that letter from the LBMA and their lawyers speak, and it put me to sleep on an airplane flight home. So I appreciate that you have some insight, can help me understand it. And real quick before we get started, I would just like to mention that today's episode is brought to everyone by Arcana Silver, which is about to go into production. And as we'll find, who knows, maybe right after Basel III resets gold and silver prices. So to find out more about Arcana, you can find them at arcanasilver.com, which is in the link in the description field below. And certainly with a higher silver price, offering leverage to that. So thank you again, Arcana, for being a part of today's show. And with that said, Alasdair, perhaps I'll give you the first question that I may repeat a couple of times over and over again, but I think what everybody wants to know, and then you can dig into it from there. Is something actually going to happen on June 28th with Basel III that is going to really end this paper gold and silver market as we know it? I think is the question on everyone's mind. And if you can even give a quick definition of what Basel III is, what it means for the context, and then just take it away.
Yeah, well, there are two dates that matter. One is the end of this month, when the Eurozone banks and also the Swiss banks will start complying with the new net stable funding ratio regulations, which have been introduced by Basel III. I'll describe what that is in a moment. But there is also another date which is more important, and that is the end of this year, or more specifically, the 1st of January 2022, when all the members, the banking members of the London Market Association will introduce this net stable funding ratio as well. Now, it has been out for consultation. We haven't got the confirmation from the London regulator that that is actually going to happen in the form in which it is proposed. But I think it is very, very difficult for the London regulator to accommodate the London Bullion Market Association. Now, the reason I say that is that, and you read the letter, it sent you to sleep. I can understand that. But if you look at it, it's actually very misleading. They write it in such a way that the reader is led to believe that unallocated gold is gold. It's not. It is not. And let me just explain that for a moment. Any bank that takes a position in gold either does it on behalf of clients, and it's physical gold, in which case it's in custody and it's not on the bank's balance sheet. On the other hand, what it can do is it can have an unallocated liability to depositors, and that appears on its balance sheet. And that's what we're talking about. Now, if I just take you through how unallocated gold, in inverted commas, is created, what happens is that the trading side, the trading desk of this bank, we'll call it the bullion trading desk, says, Well, we would like to have a facility so that we can trade the market, and we will trade in London in the forward market, and we will trade also on COMEX. And what we want is we want to have, let's say, a facility of $100 million to take positions in the market. Okay. So let's assume that management agree or Treasury agree. Now, what they then do is they then mark the balance sheet. On the asset side of the balance sheet, they then have an asset, which is money owed by the bullion desk to the bank. And then on the other side of the balance sheet, the liabilities side of the balance sheet, they credit a deposit of 100 million to the trading desk. So you've got basically, you've got on one side 100 million and you've got the other side 100 million. And the balance sheet, the bank's balance sheet, still balances. But where does this come from? It's just balance sheet entries. It is created out of thin air. It is the creation of credit. Now, the difference between this and a normal deposit is a normal deposit. You go along to your bank and you sort of open an account and you might transfer some money from another bank into that account. There is then a liability. That bank has a liability to you in dollars, okay? Now, in this case, the bank has a liability to you in dollars, but a value tied to the spot price of gold. This is not gold. This is a completely artificial thing. It's rather like when you bet on a horse in the horse race, you don't own the horse in any way. You own no part of it whatsoever. But if the horse wins, you come in and you collect. Yep. I mean, it's the same sort of thing. Now, going back to this letter, which the LBMA wrote, they wrote this in such a way that you would think that unallocated gold is actually physical gold. It is not. And I can tell you that that sort of approach is unlikely to charm any regulator out of his tree, because the regulator knows he's being sold a pup. Or if he doesn't, we should be even more frightened of regulators than we are, because they're completely incompetent.
Well, keep in mind, there is Rostin Benham and the CFTC, so let's not rule anything out completely.
I don't mention, there's no names involved in this at all. I mean, we're looking at institutions. The fact is that the regulators have a job to do, and they do that to the best of their ability. It may not be as well as something that you and I could do between us, but they are appointed to do it, and they do it. So this comes on to the point about, is this going to go through? I really don't think that the Prudential Regulatory Authority, which is the regulator in London concerned with this, has any alternative at all but to apply the net stable funding ratio to this unallocated gold market. Now, given that that is happening in the letter, the LBMA said an 85% RSF charge, this is just one side of the ratio, will undermine clearing and settlement, drain liquidity, dramatically increase financing costs, curtail central bank operations. I agree with all those points, yes. But there's actually nothing, I don't think, the regulator can do about it. And what's more important, this was introduced or pointed out to me by one of your colleagues, Craig Hemke, that because someone had sent him an email saying, have you seen this? The US controller of the currency is introducing the net stable funding ratio rule as of July the 1st. So it's happening in America as well. Now, this affects both the forward market in London and also the futures market on COMEX. Now, the reason it involves both these markets is that the players in both, we've got the same players basically in both markets. So if London's shut down, then effectively the swap category and COMEX is going to lose most of its, of its liquidity. I mean, it's just going to disappear. Now, this matters because if you look at the commitment of traders figures, On the non-spec side, you've got obviously two categories. You have got the producers and refiners and all the rest of it, and you've also got the swaps. Now, you take the swaps out, all you're left with is 25% of the open interest is actually provided by the producers, that category. So what this does is it removes 3/4 of the liquidity on COMEX. I mean, it's pretty much as simple as that. So what happens in that market if a hedge fund decides, well, we're going to sell dollars, buy gold, then it's going to, the effect is going to be a lot more dramatic than it is now. So there's going to be greater volatility. The other thing about it is that with this net stable funding ratio coming in and the banks effectively withdrawing from providing gold trading facilities, both unallocated, I mean, they will try and run unallocated accounts rather than have custodial accounts. They discourage custodial accounts by loading storage charges and insurance costs and all the rest of it. And they turn around to their customers who want to run a gold account and say, look, you'll be far better running an unallocated account, which we can do for free. Ho, ho. Yeah, sure they can. So, we have a situation where we now got to sort of look at, how much of the LBMA's banks business is with non-LBMA members. Now, we don't actually know that, but the LBMA produces figures which are only deals between LBMA figures, and the daily settlement is in the region of about 30 million ounces. That's the daily settlement. There's obviously a lot of turnover underneath that during the day. But what we want to know is how much trade actually happens between LBMA members and customers. In other words, the people who have a gold deposit, an unallocated gold deposit account with the bank. And I think looking back to the times when this was reported, and I mean, you have to go back quite some time, I think there's a very rough rule of thumb. The non-LBMA member trades are roughly 5 times the LBMA member trades, between members. So we're talking about very, very large amounts of trade on an unallocated basis. Okay, so these banks now shut down their positions. They decide they're no longer going to be in this market. What happens is that they send out a letter to all their depositors saying, we're closing the deposit account, or we're going to redesignate it as a dollar account or a euro account or whatever we account in, at your choice. But closing this down, we will pay you out at the gold price under the terms of whatever, but you're going to get dollars. You're not going to get gold because it's unallocated. It's just a derivative. So you don't get the physical. So this means that there's something like, I don't know, 150 million ounces roughly of daily settlement, perhaps, with non-members. If my sort of 5 times 3 figure is anything like ballpark correct, these guys are going to get a letter and they're going to suddenly find, I thought we had a position in gold. It turns out we haven't. So what do I do? I mean, I think in this environment, this very inflationary environment, quite a lot of these guys are going to turn around and say, well, it looks like we've got no alternative but to tell the bank to get us some gold and put it into custody for us. So you can see that this could create an awful lot of demand. Now, the only caveat, demand for physical, the only caveat I would put on this is that there's nothing to prevent a bullion bank continuing to run positions in the gold market. But in doing so, that bank would have to accept the balance sheet penalties of the new net stable funding ratio calculation and regime. So this is what we're looking at. I think it is possible that some banks may continue, but the problem is that it's actually quite a delicate operation. The way you make money in the market as a bullion bank is you run a short position all the time. It's the short position that creates the open interest on COMEX, for example. So you've got a short position. you're going to lose money when the price rises on that short position, but you make more money because you trade it. So that every day you buy, sell, buy, sell, buy, sell, and you make money on the trading. You got the spread in your favor. You've got the fact that you can read the guy who comes in, if does he have an open position with us? The answer is no. Okay, he's going to be, it's 10 to 1 on that he's going to be a buyer. Okay, so we can load the price. So you can see how this works. But given that it's a net figure, you're making profits, if you like, on the trading, in, out, and you're making a loss in a rising market in an inflationary times on your short position. Are you going to continue with this situation, netting one off against the other, if the net stable funding ratio regime introduces new hurdles, if you like, as far as the overall balance sheet is concerned? I think you will find that the treasurers in the banks are going to turn around and say, well, look, we've got to cut these operations. We reduce them down to whatever, or we just get out of the market entirely. So I think after a long period of time, there are likely to be quite a lot of dealers on bank trading desks who are going to find themselves out of work.
Wouldn't that be a beautiful surprise for the world? And Alasdair, obviously, I know there's some people that maybe they don't know what to think. They've heard gold manipulated. But to support what you've been saying there, real quick, I'd like to reference, this is the LBMA, their incredible silver report, where they a couple months ago admitted how scared they were of running out of metals. And I'd love to get your comment on that before we wrap up. But there was a particular comment here that I think speaks to what you were just saying, because let's see if we go down. Here we go. Taking in turn, even though Swiss refineries reopened and were able to deliver metal into New York, banks' risk departments continued to limit the ability of their trading desks to issue contracts. This had the effect of tightening their supply and in turn kept futures prices higher for longer. Now, it says when the bank's risk department basically said, stop shorting so much, and they're not talking, as you pointed out, they're not talking about the supply of gold, effect of tightening the supply of paper. When they stopped shorting, the price went up. And again, this is coming from the LBMA. And I guess to the larger point, what does it say about the gold market or the integrity of the gold market, where here it is, in a couple of weeks, we're sitting here trying to decipher lawyer speak where the price of gold might shoot astronomically higher. And I'll be curious if you have any forecast of what you think will actually happen to the prices. But it's like gold is being priced by something lawyers and bankers who have been caught cheating and violating rules time and time again. Is there a better way to put in perspective that the gold price has nothing to do with the actual physical supply and demand of gold? What do you think about that?
Well, basically, if you go all the way back to the Nixon shock, which was August 1971, at that point, a decision was taken by the US government, US Treasury, that they would now promote the dollar without the backing of gold as the global reserve currency. So before then, it was gold through the dollar, okay? So the policy then was to denigrate gold, to say that gold is yesterday's story, and that's something that's continuing. We've had the sort of pet rock theory and all the rest of it. That's just a continuation of that policy.
It can be used as a doorstopper too, according to alleged greatest investor of the 20th century. So keep that in mind.
Well, it can, but I tell you what, if you're going to use it as a doorstop, I hope you've got security on your home. But anyway, putting that one to one side. And really, if you like, working with that, how do you diffuse demand for gold? Well, the answer is you create artificial supply. And I have no doubt at all in my own mind that behind the authorities' policy of the financialization of markets as a whole was the thought that if they financialize commodities and gold, silver, whatever, and energy markets, they would actually absorb speculative demand, which otherwise would drive prices higher. And so what we're now seeing is an end of that era when they used the spread of financialization into commodities as a means of putting a control on commodity prices. So that basically, I think, is the situation which is now coming to an end. So it looks to me like we're entering a new era. When it comes to silver, I think I should point out that there are two big differences. The first is that central banks don't hold any silver, so they can't come to the aid of the market. This makes silver inherently more risky as far as the bullion banks are concerned. Because central banks, I mean, it's routine in London for the Bank of England to persuade those it has earmarked gold for to earn something on their gold by leasing it into people who temporarily need it. And consequently, quite a lot of the gold which is sitting in London appears to be leased. The last person who really did some serious research on this was a guy called Frank Veneroso, who spoke about this at a conference in Chile back in 2002. And he concluded at that time, when there was roughly, I think it was 33,000 tons of official monetary gold. This is gold held by central banks against their liabilities. And of that, he reckoned that somewhere between 10,000 and 16,000 tons was out on lease or being swapped. Now, this is huge. So you can see that from the authorities' point of view, there is this, if you like, desire to try and deflate demand by absorbing it in such a way that it doesn't drive up the price. And that basically is what leasing does. So without the Bank of England, you can see that there's no leasing of silver. So anyone running a short position in silver can't go around to the central bank and say, have you got anything to lease because I need to balance my books? Leasing also, but just sort of on gold just for a moment, leasing I think has become a lot more sophisticated. So in the old days when Frank Veneroso was around, gold was delivered into the market, it was sold into the market, and it was bought back. Now remember that up until the early 2000s, we were in a bear market. Now in theory, it must have been relatively simple to buy back the gold. But in practice, I think it was actually a lot more difficult. Guess why? Because the Chinese, in 1983, decided that they didn't want to have just dollars and other capitalist currencies, because they reckoned that, I mean, the Marxist universities in economics taught one simple thing, and that was that capitalism had the seeds of its own destruction and their currencies would go down with it. So China doesn't want all these dollars and everything. It wanted something else. And of course, I don't know if your listeners know or your viewers know what the Chinese for gold is, but it's the same word as money. So, money is money. So gold money in China is money, if you like. So this is a fascinating thing. China was basically mopping up all the loose gold, including stuff.
By the way, Alasdair, I don't think Jerome Powell or Ben Bernanke are aware of that translation, apparently.
Well, maybe not, but they would be in denial, I think. If
that is true, I agree.
But I mean, look, officially they've got to deny it. We're not privy to their deeper thoughts, if you like. We know what their official response is. So that gold probably never really came back. Now, nowadays, I think what happens is that the leasing of gold basically means it doesn't actually leave the Bank of England vault, but there's just if you like, a ledger entry occurs. And that's the extent of the transfer of gold. I mean, the reason I say this, or I know this, is because back in the days when Frank Veneroso was doing his research, I used to lunch with Terry Smeaton, who provided Frank Veneroso with his information. I used to lunch with him about a good, sort of once, maybe twice a week. I didn't ask him all the questions on gold. He was actually head of the foreign exchange department. than the Bank of England. And the reason he was there was we lunched at the Bankers Club, which was at the back of the bank. And I think, like quite a lot of people, sort of fairly high up people, they like to get off site, if you like, just for a little bit of the day. So rather than lunching in the canteen, he used to come over to the Bankers Club and lunch there. Really nice guy, and all the rest of it. He's dead now, unfortunately. I'd love to have asked him all the questions, if you like, for the benefit of hindsight. But anyway. And at the same time, we used to see these security trucks going in and out of the back entrance of the Bank of England. I mean, twice a week, there was very, very heavy traffic. They're almost queuing up at the back of the Bank of England in Lothbury, which was the street where the entrance is. So that doesn't happen now. But believe you me, there's a lot of gold which is out on lease. And this leads into another thing, which, why was it that the Bundesbank decided to get its gold liquidity back, first of all, out of the Bank of England, and secondly, out of the New York Fed? I mean, the official answer is that once the Berlin Wall fell down, there wasn't the threat from the East, and therefore they felt that there wasn't much reason to hold all their gold, if you like, as far away from Germany as possible. Yeah, I can accept that. But I wonder to what extent the stories going around the Bundesbank were that perhaps our gold is being leased without us being told. Now, if that is the case, then you can see that there would be a lot of pressure for that gold to be returned. And not just pressure from the general public saying, why is our gold away, but also, I think, internally. Reverting to silver for a moment, there is another aspect of the problem that we've seen recently, and that is that there is no liquidity. I mean, there really is very little liquidity in both gold and silver in London and on COMEX. The priority, as far as the LBMA is concerned, and as far as the banks are concerned, has been to get the refiners to concentrate on refining gold coming in. I mean, it's both scrap gold, newly mined gold, whatever. Get that refined. We don't want the backlog there because we need that immediately, which means that they have put to one side the less profitable refining of silver. And that has created a bit of a backlog in terms of the availability of physical silver as well. So going back to that note that you just read out, there are those dynamics, I think, behind it. And we had the interesting situation, which didn't really help matters, where, according to the LBMA, one of the vaulting members misreported its holding of silver.
Oops.
And of course, amongst all the gold and silver bugs, we all think this is, this is deliberate obfuscation and all. Look, I don't know. I really don't know, Chris. I don't actually care. All I care about is that we're talking about sound money, and we know there's a shortage of it. And we also suspect that the regulatory changes that are coming through from the Bank of International Settlements are going to make it almost impossible to acquire bullion at anything like current prices as this horrendous monetary inflation spins itself out. I mean, we really do, we are on the edge of not just the sort of this inflation thing that goes away. That's not going to go away. I mean, you believe that, you believe in fairies at the bottom of the garden. This is real. And not only is it real, but I think we've, John Williams has been, I think, very sensibly on a number of websites telling people, look, the rate of inflation, the true rate of inflation without all the adjustments that make it look as if it's nothing, the true rate of inflation is between 11 and 12%. Now, if you accept that, and I do accept it, it was also confirmed before they shut down. I don't know if they've reopened, but the Chapwood Index, which sort of worked it out on regularly bought items. I mean, something like, I think they're around 50 cities, 500 items, 50 cities, track the prices twice a year. And that was also confirming a rate of price inflation of over 10%. And not only that, but when you see that how you've had this massive expansion of the quantity of money in America since, I mean, particularly since March 2020, when the Fed started doing 120 billion a month of QE. It cut its funds rate down to 0 the Friday before. So that was on the 19th, 20th, on the 23rd. You know, this new accelerated QEs really started from then. The amount of money that's been printed to finance, you know, government spending, anything you like, to ramp up markets as well, is unprecedented. I mean, it really is, not just in quantity, but in terms of in relation to the size of the economy. So this is really major. So I can believe what you know, what Shadow Stats is saying. I can believe that, and I can further believe that this rise in price inflation has not stopped yet, and it's going to go further. Okay, so the question we need to ask ourselves is, what is the appropriate rate of interest to reward the foreigners for holding on to the dollars? And when I tell you that the foreigners own roughly $30 trillion, 1.5 times the US GDP, they have got an awful lot of dollars that we've got to persuade them to hold on to. Otherwise, the dollar is going to go through the floor. So, you know, what's the rate of interest? Now, if you're going to equate it to the true rate of price inflation, then we're looking at not 2% yield on the 10-year, not 3% yield on the 10-year, but we're looking at something which is closer to that 10, 11, 12, 13, 14, 15%. So now we won't get there immediately, but you can see that the conditions are there for a crash in the US Treasury markets. That obviously undermines the situation for the US equity market. And this is why I've been telling people that, you know, I look through history and I see this as being an absolute dead ringer for something that John Law did in France exactly 301 years ago. Now, I started talking about this when it was 300 years ago. It's now 301 years ago, 1720. The Mississippi bubble. He puffed up the bubble basically because he was controller of the currency and he could print livre to go and buy shares in his bubble, which he did. And he did it in some style. And he pushed the bubble up. But the problem is that bubbles eventually stop, just the same as the American financial asset bubble will also stop. Now, when that happens, what happens to the currency? Well, the answer is that the currency's future has tied itself to the future of the financial assets. And if you get a collapse in the stock market, collapse in the prices of US treasuries as the yields rocket up and catch up with reality, then the dollar's going to go with it. And this was played out by an Irish French banker called Richard Cantillon, who we know in another context. We know as one of the great early economists. He worked out how to play this, and he made his second fortune. The first fortune was also out of John Law's scheme. But the second fortune, he decided that the way to short this ridiculous situation was not to sell shares in John Law's Mississippi venture, but to short the currency, which he did in London and Amsterdam, which were the two foreign exchange centers at that time. And anyway, basically, the shares went from around about 12,000 livres each down to 3,000 or 4,000 livres, quite a fall. But what was really the real fall was in the livre, because on the London exchange, it went from a value, I can't remember what it was. I mean, it wasn't that high, but the important point was it went to zero, big fat zero. That's the way to play it. So if you're a foreigner with a little part of that $30 trillion, the way you play the dollar is quite simple. The way you play US financial assets is quite simple. Short the dollar. And that's what's going to happen. The dollar is going to go through the floor. And what we're actually saying is that the purchasing power of the dollar is going to dissolve, if you like. And when the purchasing power of the dollar dissolves, guess what? The purchasing power of gold will, it will retain its purchasing power, which basically means that the relationship between the two is you will see the gold price way up there somewhere, in worthless dollars. Now, this is why I never, ever make a forecast about gold prices, because the assumption is always that the reason I'm making this forecast is I'm buying gold and I'm going to sell gold once I've made my forecast, and I'm going to go back into dollars. No, I'm not. I'm not interested. I'm never going to sell my gold. I'm going to spend it. That's how I will finally deal with my gold. And this is the important point. So never, ever, ever make a forecast of the price of gold. It's an idiot's game. It really is. And I don't play it. So anyway, I hope that sort of explains a little bit about my, my thinking about this situation and why what this Basel III thing is likely to do. I think it's just going to make a bad situation potentially considerably worse. And I think, once things start sliding, I mean, if we start seeing the dollar slide, it will be reflected in the gold price, which doesn't stop at 2,000. It'll go on and on and on up. And it will be very difficult for anyone to buy. And the reason they will find it very difficult to buy is they're still thinking in terms of dollars is money, gold is going up, I'm going to get out of my dollars into gold with a view to coming back into dollars. That's the wrong way to look at it. I mean, the better way to look at it is, okay, Macleod might be talking absolute rubbish, but on the off chance he's talking a little bit of sense, I'm going to have an insurance policy. And that insurance policy is to own a little bit of gold, just in case. Just in case. I think that's probably the way people should look at it. And if they agree with me, then, that's, I mean, the other thing is that the difference with an insurance policy is you pay the insurance policy and you don't get it back. And this one, you will get it back. You may not get it all, you may get multiples of it, but it's not money wasted, if you like.
Yeah, and I really appreciate you mentioning that. I don't think it's that people don't want to understand it. It's just a little confusing, and you put it in great context because, I get that question a lot. Well, what price do I sell my silver? Maybe in a different environment, I could see digging into that question more. But it's like, if that's money, I hear people talk about the price of gold did this, did that. And I'm like, no, the price of gold was an ounce of gold. It's still gonna be an ounce of gold tomorrow, a million years from now. It's the dollar that's changing, and especially in an environment where I can't see, all right, they could stop printing, but there goes your stock and bond bubbles. So maybe the analogy we used to use in option trading land was that, let's say I give you a $50 bill. I mean, you're not going to rush out to lock it in for 4 10s. I mean, because it's just you use it and spend it. And I think as time goes by, perhaps that will be easier to see. Yet, Alasdair, you mentioned silver a couple of times. I actually did have an interesting question I'd love to run by you. I've not heard of any central banks buying silver yet. I mean, we hear anecdotally, maybe China's buying silver. Someone was asking in particular to Russia, and certainly with Putin, who is very adamantly talking. I mean, when we don't get much coverage of him unless you're looking for it here in the West, but not only does the guy say exactly what is on his mind, he puts the country's monetary actions behind it. Is it possible that, I mean, I'm guessing, they didn't contact me yet, but I mean, this isn't rocket science. Could any of these governments start loading up on silver, especially one that has made it clear they're sick of the US dollar bullying everyone around? And I mean, that's why I started the channel, because it seems like the biggest Achilles out there to me. Any thoughts on that or anything else regarding silver here?
Yeah, I mean, as a starting point, I don't think any central bank actually anticipates backing their currency with gold. That's the first thing. Things have got to evolve, and I think it will drive central banks into a corner, because when they see the currency going down, I mean, just imagine they're in the position of John Law, let's say in halfway through 1720, or alternatively, they're in the position of the Reichsbank in 1923. You see the paper mark going down and down and down and down. At some stage, you've got to stabilize it. Now, how are you going to stabilize it? I mean, the way the French did it after just sort of through the revolution.
Actually, if I can interrupt for a second, please. I know how they're going to stabilize it, or they're going to attempt to. they're going to print more, which of course is a little backwards, but we know that's what they're going to do. That's all they do.
Yeah, no, but I mean, I'm talking about the situation where they suddenly, they realize that, this is just completely out of their control. The only thing they can do is to take what gold they've got in the vault and back their currency with it. Now, if the rate at which dollars are backed to 300,000 to the ounce, then that's got to be the rate. And but I think the point I'm making is that at the moment that no central banker is thinking that gold will be mobilized to back any fiat currency. That's just not on the agenda. So we're looking through to a time when that will happen. So I think this answers your question on silver. They've got a sort of idea as to why they should hold on to gold. In Putin's case, it's quite simple. It's the alternative really is the dollar, if you like, as the major international hegemon in the currency world. Okay, that's fine, but I don't want to hold dollars, he says. So what does he hold? He holds gold instead. Why? Because gold is nobody else's liability. So you got gold, you got gold. It's actually as simple as that. But I don't think he intends to back the ruble with it. I don't think the Chinese intend to back the yuan with it. I expect that situation will change. And the reason it will change is that there will come a point when currency, because there isn't a decent currency anymore. So, and the politicians can't get paid in a decent currency because the currency is going through the floor. So they've got to stabilize it. Now, I expect that the initial attempt at stabilizing it will probably fail because they won't do it properly, or it will just sort of be a holding operation while everybody scratches their heads and thinks, oh, what do we do now? Won't work. So there's quite a lot to go through before we get a solution to this. But the point is that if gold is not even on the agenda at the moment of being remonetized, which is the way the central bank will put it, then certainly there's absolutely no way they're looking at silver. But the way we should look at silver, in my view, is that it is a monetary metal. And just because central banks don't hold it doesn't mean to say we shouldn't hold it. We're going to see a situation where eventually, and I think once it starts to happen, it'll happen very, very quickly, fiat currencies will disappear. And then you have to ask yourself the question, who is going to, yeah, absolutely, but who is going to decide what the new money is? And I can tell you, it will be people like you and me. We have silver, we have gold. We will spend it back into circulation, and we will enjoy spending it back into circulation because we'll be able to buy things incredibly cheaply. I mean, they'll be very expensive in dollars. I mean, I'll give you an example. Back in the German inflation in 1923, in the middle of 1923, you could have bought a 6-bedroom house in a swanky part of Berlin for God knows how many. I mean, I haven't worked out how many paper marks it would have cost you, but I mean, we're talking about huge quantities. I mean, billions. But you could have also bought it with foreign exchange, dollars. It would have cost you $100. And in those days, the rate between the dollar and gold, fully exchangeable, was $20.67 to an ounce of gold. So effectively, you could buy a 6-bedroom house in a swanky part of Berlin for less than $5. Now, what's wrong with that? That is the position. If you actually do have some gold, some silver, then there will be people who will want that gold and silver in exchange for real assets, in exchange for food. Now, this brings me on to silver because, or even more on to silver, because silver has always been, if you like, at a lower value than gold. And it was set by Sir Isaac Newton at around about 15.5 to 1. There was nothing magic in the rate. That was more or less the market rate at the time. But what we're looking at, I think, is it returning to that sort of level. So for people who want to really accelerate the, if you like, just catch up from the losses that they have made by not moving into physical gold or physical silver, one way in which you could do it is to go into silver and to benefit from the fall in the gold-silver ratio as metallic money begins to be more regarded as the solution to the collapse of fiat currencies.
Well, as the old saying goes, is there anything silver can't do? And Alasdair, perhaps two last ones before we wrap up. First, why do you think why are they doing this? Is it that someone really is concerned about the financial system? Usually governments don't seem to care. Maybe they're just worried about losing their power, or perhaps we're at the point where they've just run out of the metal to continue this scheme. I know Hugo Salinas Price has talked about, he thinks Russia and China are putting a gun to their head. Why do you think right now they are scheduled to go through with this? Why are they doing it?
I think, what are we talking about? We're talking about the Bank of International Settlements. The new regulations. The answer is actually very, very simple. And I think it's a mistake to sort of think that they're huge, great sort of motivations in the background. They're not. That Lehman crisis scared the pants off everybody. It really did, and particularly the people in power. Interestingly, we've got a journalist here called Robert Peston, and he used to be a journalist on Financial Times. And it was about that time that he moved over to the BBC. When I say about the time of the Lehman crisis, he moved over, and he interviewed Hank Paulson, who you may recall was, trying to handle this situation from the U.S. Treasury's, I think, U.S. Treasury's point of view. Yeah.
Oh, I thought you meant the Goldman Sachs trading desk.
No, but I mean, the guy who I think was he was a Treasury guy who was handling this thing. Yeah. Well, he told Peston that he obviously had to talk to the Chinese and Russians because they were creditors through the treasuries with their very large holdings of U.S. treasuries. The Chinese were quite sort of understanding in the situation and didn't really feel that they should rock the boat. It was a very different thing with the Russians. The feeling that Paulson got was that the Russians were very much on a knife edge as to whether they would just destabilize the whole situation. Now, this ended up on the cutting room floor. It never actually was broadcast, but it was on Peston's blog. So the journalist concerned actually wrote about it. So I think we take that as true. But what that basically tells us is that I think that the officials who were concerned at the time of the Lehman crisis were absolutely terrified about what they found. And they did not want to see this again. And, I'm sure that other elements of the US government, like, the intelligence services, the defense community and all the rest of it, who think there's a greater priority with the enemies of Russia and China, and we can't let them threaten our hegemony, if you like, either the currency hegemony or indeed our military power. We cannot allow that to happen. But the fact of the matter is that America and the world was on the edge of a complete financial collapse. They managed to manage their way out of it. And it required an awful lot of bluff, if you like. It required people in the markets to be convinced that they would succeed. Unfortunately for all of us, they succeeded. Now, what came out of that was the G20 instructed the Bank of International Settlements Basel Committee to come up with new regulations to ensure this never, ever happened again. Those regulations were finally agreed. I mean, they went out for consultation in the spring of 2014. The final version was published in October 2014. And here we are nearly 7 years later, finally implementing Basel III. That is going to happen, and it cannot be stopped. I mean, there may be a little bit of fiddling around the edges. I can understand that. I mean, for example, if you're looking at derivatives, because derivatives are a very important part of this. According to the net stable funding ratio, you can offset derivatives on either side of the balance sheet if those derivatives, the positions are dependent on each other. So in terms of, say, COMEX, it's rather like looking like at, as a spread position, So that you've got longs, shorts, and spreads reported. Okay, a spread basically is you sell, let's say, one maturity to buy another maturity, and as time goes, they close up and you reverse it. Now, both legs are dependent on each other. Under those circumstances, you can net them off, but anything else, you can't. Now, there's a little bit of maybe bending of rules by some regulators possible in that context. But basically, the answer is that this is now written in stone, and I don't think there is anything the deep state or anyone can do about it on the basis that they have got more important priorities.
Well, it does sound like it'd be hard to tamp that down. And last one for you, I think will be a great way to end it. I think we are, what is today's date? June 10th. So let's say we take our time machine and we're on July 10th. What has actually happened? And you don't have to give all silver is at this exact price, but do we see on June 28th, is it a wild Lehman-like event? Are gold and silver prices on that day trading exponentially higher? What actually happens when this goes through?
Well, I think that what I would say is that this is unlikely. This is not a waterfall event, in my opinion. I don't think you're going to find that on July the 1st, all the American bullion, banks' bullion desks are going to turn around and say, right, we're going to cut our positions, bang, like that. We're going to shut up shop. No, they will be given a grace period in order to do it. Apart from anything else, if you look at the losses on COMEX for the swaps, I mean, at the moment, they're net short, I can't remember the figure, something like 30 billion, something like that, $34 billion net short. I mean, now they haven't got a 34 billion loss because they're not short at zero, but you can see that they've got quite a large position that needs to be closed. You cannot do that overnight. So I think what they will try and do is they'll try and evolve their way out of the problem. So I think it would be misleading for me to turn around and say, well, in early July, you're going to see the gold and silver price start going up because everybody's going to be closing their positions. Well, the banks are going to be closing their positions. I mean, I honestly don't know, but I would suspect that unless there is a panic, and that's possible, this could actually generate a panic amongst the bullion bank trading desks. But unless there is a panic, I think that they will try and just sort of smooth their way out of it. So it'll be a gradual reduction, I think you'll find. I think what's probably more important, a lot more important, is the interplay between the rate of price inflation, expectations of where price inflation is going to go, and what that does to the dollar. That, to me, is going to be the big question. Now, within that context, it is possible that higher interest rates are bandied as a reason for selling gold, on the basis that if you hold gold, you're going to be missing out on a 1% interest rate or whatever. I mean, now this is complete rubbish, but it is the sort of thing that is bought, if you like, by short-term traders.
Wall Street guys, they love it.
Absolutely. So I wouldn't put it past the bullion bank trading desk to try and get that view across, if you like, to help them ease their way out of the position. So this isn't going to be a sort of sudden done deal, I don't think.
I can hear the Jeff Curry commentary right now, and it's going to be exciting.
Exactly. Anyway, Well, we know that argument is complete rubbish, but you know, there are a lot of people in the market who don't necessarily, and this is where, you know, if you make the mistake of thinking that gold is an investment or it's something which I trade, you know, the hedge funds do this all the time. You know, they're into pairs trading, so they will sell dollar, buy gold, or buy gold, sell dollar. What, you know, and they don't think beyond that. They look at the chart. They look at whatever it is they look at. I don't know, and they then take a decision. But undoubtedly, in the back of these guys' mind, there is this thing that if interest rates go up for dollars, then that's going to make the dollar more attractive relative to gold. So perhaps I should buy dollars, sell gold. You know, you can see the thinking is completely false and it's completely wrong. It misunderstands the situation completely, but then that's the world we live in.
Well, Alasdair, I believe that's why they call them bankers and government officials, sometimes alleged regulators too. So I sure appreciate you shedding some light on this. And it's going to be fun to watch it unfold. Actually, a quick special note before we add, because this will be at the same time that, because last night I did finally read my scripts, which will be sent over to my YouTube ads team that I bought myself as a present. So we're about to plaster all of YouTube. You know, before you watch a video, you hear me saying, buy silver now. Just get it in the subconscious to give the bankers a little extra. You know, I know how they're like action junkies at the casino. So let them try and unravel their short positions while we have even more people realizing the virtues and the benefits that insurance against bankers and governments can provide. And lastly, I would be remiss if I did not mention your great site, goldmoney.com, where in addition to finding your incredible research that CNBC fortunately can't locate and distort, can you just tell folks a little bit about Gold Money, where they can find the research? And also, you know, again, I understand if you don't hold it, you don't own it. So just a second on how people know that if they do use the Gold Money products, that the metal is there, audit procedures, anything, just so they know what they are getting there.
Yeah, I mean, the key to understanding what Gold Money does is it holds gold and silver and platinum group metals, if you want, in custody. It's not on our balance sheet. It's under Canadian bailment law, and it is outside the banking system. And all gold and silver and platinum group metals is held in fully insured, high standard vaults, you know, vaulting companies who at the moment are all members of the LBMA. And I think we offer something like 10 or 11 vaults around the world. So, you know, if you want to store your gold and silver in a different jurisdiction from where you live, which could make it a bit harder for the feds to get it out of you, as it were, then you have got that option. So really what we're looking at is trying to ensure that through these very, very difficult times, which are just getting more difficult, people can preserve their wealth for their future use. And that's basically what Gold Money does. And I write a research article every Thursday. It's published in the sort of, you know, mid-afternoon on EST on Thursday. And you're scanning down these past articles. And I also do a market report, and that comes out on Friday, again about Friday afternoon. And basically, it's a sort of summary of what I've seen, what I think has been happening in the markets over that past week. So, you know, it's not a blow by blow, but it's something which hopefully might have just one or two items of interest in it for readers from time to time.
Yeah, and I sure appreciate that, because after the LBMA comes out with more propaganda, people can read, make jokes about that, then come over to find out how it really works. And again, I appreciate what you guys do at Gold Money, because if people don't want to leave their gold and silver in Bernie Madoff's vault, I'm sorry, I meant JP Morgan's vault. I get the two confused all the time, given their close relationship. And one of JP Morgan's past deferred prosecution agreements, which, and I'm only supposed to have one of those, but we'll leave that aside and just thank you again, Alasdair, for shedding some light on this. Exciting times, and good to know that the end of the tunnel, you see that light in there, however the dominoes unfold. But I think what is clear is that people love hearing from you. They love reading your stuff. It's really been an honor to get to know you and call you a friend as time has gone by. So thank you so much. And we'll look forward to checking back in next month, hopefully.
Well, thank you very much for your kind words, Chris.